Now the next thing that I focus on is the high and the low of the day. Now what's important to understand and why I look at multiple instruments is that if you try to trade the same instrument every day, every session, then you're going to get caught inside of the high and low. You're going to be chasing moves. You're potentially going to get caught into low probability movements. Your results are going to get inconsistent and you'll get frustrated from getting whipsawed back and forth. What I'm looking for are some basic setups that are all the same no matter what the instrument. And what's important about this to understand is that at the high and the low of the day, there are orders. Take profit orders, breakout orders, stop loss orders, and in most cases the average retail trader's stop loss will be at the high or the low of the day, of the week. As the day evolves, Asia will often give us a high and a low. But we may also be inside of a larger structure from the previous session, the US high and low. We could be inside of the US session high and low when Asia gives us our new high and low. We may even be around numbers. We could be around numbers or inside of numbers. But the most important part to understand is that everything inside of that high and low is caught inside of where these stops are. And at some point, whether it's before London or in the Asian session or in the rollover and gap time heading into the New York session, at some point they will come outside to hit these stops either in the gap time, and that will usually be 25 to 50 pips above or below this range. I will wait no matter what until the market breaks one of these levels, whether it's the high and low of the present day at the timings, looking for very specific setups with the engulfments and pin hammers, the W's and M's, which we will go into in detail. But if you are trading inside, chasing these swings, thinking you're selling the high or catching the trend, at some point what you could be end up doing is jammed inside, and then right before the 12 candle window starts, you'll see 3 bursts potentially where they take out the high, or they looks like it's going down, and then all of a sudden it stops, and bang, 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 they go to the high, they hit stops. And again, remembering and understanding that there's money sitting above and below. That money, if they don't go and get it, or if they've already gone there and they're reversing, they aren't going to go back, because that allows losing traders to get out of the position without a loss or a smaller loss and maybe even a small profit. If the smart money has profits locked in, they are going to go to the other side, whether that's to get liquidity. People call it liquidity hunting, stop hunting, whatever you want, that's where the money is. So it's important to understand that if you're inside of the high and low, you want to either be in a breakout pullback continuation for a new high to be established, or if they're working into a high, that you're looking to sell high in a downtrend or buy low in an uptrend. Very important. Let's look at some specific examples of highs and lows of the day on multiple instruments to demonstrate that it doesn't matter which pair you're trading. It doesn't matter which instrument you're trading. It doesn't matter what market it is. If there's a high and a low at those timings when the markets are trading, specifically the equity market hours, and the market goes there, there are very specific behaviors of price when they get to those levels that can establish as to whether or not there is a trade opportunity presenting, or if it's just a stop hunt for a fast reversal back to the other side where we may see the trade set up there.
Here's an example on the Japanese yen. Again, this is not a pair that I very rarely, if ever, would trade, but just to demonstrate, again, just the process of high and low of the day, and then understanding, are they working the high or are they working the low? So we take the U.S. session high as we head into the next day. There's our high. And our low, which ends up being the low of the week. This is actually I'll just bring this back up to show this is a Monday. Pink line designates Monday. Prior to the Asian session opening, we have a high of the day put in place, which we will mark off. I know there's indicators available and all that, but I'm just demonstrating the high and the low and then understanding what we're looking for. So they pull back and engulf just prior to the equity market hour in the first hour of the 12 candle window, giving us a low of the day. The market then proceeds to work. It pulls back and breaks again, giving traders a W formation. The market works down into the W again, pulls back to the numbers, 105.50, works back again, giving another variation of a W prior to our Europe-London 12 candle window. So we have two Ws already. But the point that I want to emphasize in your process is they've put a high in place, they've put a low in place, and then they've proceeded to work the low. They're working down into the low. They put a low in place, they worked back into it. They worked back into the low. They worked back into the low. They've given you a W formation in the equities hour, a W formation in the second 3-hour window. So the thesis then is, have they put the low in place for the day? If they have, as we come into the Europe-London 12 candle window, if we were trading this pair or any pair, any instrument, working the low, working the low, working the low, working the low. If they've locked the low of the day in place, I'm looking for long trades. Engulfment, pin hammer in the London window. This pair may traditionally move better in the US session. But my focus is on, they've put a high in place, they've put a low of the day in place. Did they extend the range out? No, they worked into the low, they worked into the low a second time, they worked into the low a third time, and then they broke out of our lower geometrical structure, which we can put a high and a low on, targeting at least 2 full expansions or a full expansion of the high and the low of the day, which the market did not fail. It failed to do, but it got up to the round numbers. And in this particular case, obviously this pair will only move probably 3 levels of rise, 25, 25, and 25, which we will discuss in other videos. But we put a high in place, and then we put a low in place, and then they worked into the low before moving back through the high of the day with a trend trade. Looking at the pound yen, and again Friday, Monday, and a great example, there's a big picture scenario here that traders can identify with, and then we'll look at the high and the low of the day. So on the Friday, the market was on a third level blow off after 150 pip rise. It put a long trade in place in the Asian 12 candle window, went up 50 pips, and then came down 150 pips. 3 levels of drop, 50, 50, and 50. But as we head into the new week, there's a couple things that traders can pay attention to. So the market went straight up and straight down, but then the market put a low of day in place prior to the US session. Then it came down into the low of the day a second time. So we have a new low of the day as we head into the US session. And we have a high of the day, a new high, redrawn high of the day. Then the market proceeds to work the low, pulling back, working the low again before giving us our engulfment. And we'll blow this up for traders to see. So we put a low of the day in place after 150 pips, almost 150 pips from the high. They came down a second time, pulled away. So we have a new low of the day in place. We have a new high of the day in place. The market then came back into the low before pinning up. There's our middle structure. Came back in that third hour as the equity hour was closing for a third push, and then our engulfment, our pin hammer for the retest into traders who have gotten the trade right, for our W reversal off the low of the day. So again, asking yourself, did they work the high? They put a high of the day in place, but then they screamed away from the high of the day, made a new low, then they extended that low, pulled back, and then they worked into the low in the 12 candle window, pinning up, hitting it a second time, giving us our W formation, our W off the low of the day with an engulfment and pin hammer. So as we head into the Monday, we're inside of the high and the low. They worked down into the low, locking in the low of the day. Traders who are long heading into Monday are still long. If they haven't been pinned in the rollover, they put a new high of the day in place. Okay, so we're inside of Friday's high and low. We have a high of the day put in place. And again, we'll blow this up. We have a high of the day in place. The market then gives us a low in that first hour, and then in the equities hour, they go down 1, 2, 3 engulfment to put our new low of the day in place. So we have a swing high. They pin up to the swing high. We have our low of the day. They work back into the low of the day. They're working down into the low of the day, and they take out the swing high. They work back down into the swing low. Okay, so again, market's making new highs, but it's working back into the lows of the day. Market gives us a swing low, not really with a doji, but they work it down in the 12 candle window of the Europe London Open. And again, so the question we are asking ourselves, we're in the middle of the high and the low, but they worked into the low of the day. They worked down into the low of the day. They put a high in place. They put a low in place in the 12 candle window, and then they worked back into it. They worked back into it. They worked back into it. Back down into it. They take out stops on the swing traders that have shorted that lower level short. They hit the stops one more time, and again at the numbers. So we're in a 50 pip box. Our high of the day is still intact, and our low of the day is intact, but they've been working down into the low of the day. The market heading into our 12 candle window breaks above the Europe London high, which is inside of the high and the low of the day, and then breaks out, and then in our 12 candle window, 1, 2, 3 engulfments on top of the Europe London range. So they take out the high of the day. They put a high of the day in place, and they put a low of the day in place, and they worked down into the low. They worked the low for the W formation. We have a reverse head and shoulders formation here. They stop hunt the right shoulder. They break out through the high of the day. They come back 1, 2, 3 engulfment. Our bullpen hammer. Some traders might not call that a bullpen hammer. When I get the bull candle with a tail on it after the engulfment, to me that's a bullpen hammer. We're in the market long. We have a 1 bar stop, a 1 ATR stop, whatever that may be. Our stop is below this swing. So we broke out, pull back for the continuation. But also, we're back inside of Friday's high. We're inside of the high and low of Friday. The market worked the low, broke out, worked back down into the low for the move back through the high of the day. So again, the question we want to ask ourselves is, when they put a high in place and a low in place, are they working the low? Are they working the high? If they extend one of those out and continue, is it a breakout pullback continuation for a trend trade? Or are they doing an extended stop hunt into the high for our 3 push pattern to give us our M or our W reversal? And again, we'll focus specifically on the round numbers in one of the next couple videos, but again, we want to see the high and we want to see the low, and then ask ourselves, are they working into the low? Are they working into the high? Or are we in a trending day? Looking at the pound Canadian, so again, just using the highs and lows from each day. We had the Fed on the Thursday, and the market obviously whipsawed both sides, trapping traders in the middle, then hitting the stops on both sides. But again, then the question we ask ourselves is, they've put a high in place, they've taken out the low, and eventually confirmed this as a low of the day, and then they worked back down into the low, pull it up, work back down, and then into the rollover. They work down into the low, pinning the swing lows with the rollover wick. Not everybody's data will be the same, but it's obvious at this stage that they're working the low as the new day begins. They work down into the low, they pull it up, they work down into the low in the 12 candle window for the engulfment, and our short and W formation in the Asian session, which again we talked about in one of our previous videos about structure. So we have a lower geometrical structure, a smaller pattern within a pattern. There's our lower rectangle. So again, if we're coming to the screen in the Europe, just prior to the Europe Open, we already have a smaller geometrical pattern that's been broken, our W formation in our 12 candle window. Our thesis would be that this market potentially now has put the low of the day in place, which means then that we would be looking potentially for long signals, so buy low setups. The market breaks through the lower geometrical rectangle. They pin up, our high of the day is intact, but traders who have gone to break even if they shorted the market on Friday, I'll blow this up again, have been stopped out at break even. And then the market works down into the numbers in our 12 candle window. 1, 2, 3 down, inside bar, almost a double inside bar for the stop hunt to the high, so that again they extend the range. We've talked about extending the range and then extending the range. We can talk about hitting stops on the upside, pulling back inside, and hitting stops on the downside. This is often a scenario that you will see if you're looking for a long trade. They may break to the upside first, triggering breakout orders, getting swing traders to take the trades long, hitting stops on traders that have shorted the market already. Again, hitting traders stops that may be at break even from the Friday trade that have still held on to it before pulling it back into consolidation, and then 1 push, 2 pushes, 3 pushes into the low of the day. So we talk about understanding timings. This is roughly 3 hours of movement, and the market has only moved 25 pips. It hits the stops on traders that have gone long early on the first leg, or traders that have moved stops to break even or been trailing the market from the Asian session long. They may have moved their stops when the market broke the highs, but the market extends the range, pulls back inside, hits the stops, extends it on the downside before pulling back inside and giving a 3-bar engulfment reversal, working back towards our new high of the day. And just prior to our 12 candle window, the market still has not broken through the high, and then we get our engulfment at the high of the day in the first hour, trapping traders chasing the move down on the 1, 2, 3 stop hunt scenario into traders that are long from the low of the day stop hunt. And again, our thesis is that the low of the day is already in place, and we have a high of the day from Friday that we're still potentially working back towards. The market then in our equities hour engulfs the 3-bar engulfment. So we have our first hour, then our second hour trade set up for an open drive breakout and a measured move of this geometrical structure. So again, if we come back and talk about our measuring tool, just even looking at 50 pip boxes. This market broke out of a 50 pip box for a 100 pip move straight up. But again, the high and low of the day, were they working the high or did they work the low? This is an example of where they put the low of the day in place in Asia. London was the middle of this potential move up. So again, we're not going to have the high of the day. We already have the high of the day. So for this market to put a new high of the day in place, it would have had to extend it out or broken down and came underneath of the round numbers. But we put a high of the day in place. We had a low of the day. They worked the high. They worked the new redrawn low of the day before pulling back inside and doing 3 push creeper up to the high. And then a 1, 2, 3 stop hunt into the breakout off the low of the day for our second W formation. Okay, we had our low of the day in Asia for our W, and then our bigger structured W in the 12 candle Europe 2-session window. And again, if we put our measuring tool on that high-low, we're looking at least 50 pips on top of the numbers. This market did 100 pips straight up, taking out the high of Thursday. Then as we head into the Monday, so again, we're focusing on the high and the low of the day. So hindsight, all those things are irrelevant. We have a structure up top. The market gave us a swing low as we headed into the 12 candle window and then gave us a high of the day scenario in Asia. So we have our high of the day, we have our low from the US session close for our upper geometrical structure. The market broke out of that structure. We have a new high of the day in place. Then it gives us a swing low. It breaks the low. So traders can say to themselves, we're working the low, but we now have a breakout, pullback, continuation. Pullback prior to our 12 candle window, we're on top of the round numbers. We have our new redrawn low of the day. The market breaks through that in the first hour prior to the equities hour. And then 1, 2 engulfment underneath of our pin hammer structure. So again, if this was working the low, if traders have hit this going long into the down move, so we have our descending triangle formation setting up on top of the round numbers, and then our engulfment after the middle structure has been put in place. So we have our high of the day, our low of the day, and a high of the day. They've broken the high of the day. They've pulled back into the breakout. We have our higher geometrical structure. So I talk about the importance of structure. They've broken that structure. They've worked the low, but we are now in a breakout pullback continuation scenario off the round numbers. We have at least 50 pips between the structure and the profitable trade from Friday. So again, where is the money? This scenario makes complete sense for the market to want to go back and stop out traders who are in the money from Friday. We have a geometrical structure. They break out, pull back, continue the move, engulfment, pin hammer at the open of the London equities hour for a 50 pip stop hunt. Now we put a low of the day in place. So you'll notice this is not a low of the day yet until we get the engulfment, and then the market comes back in the US session 12 candle window. So again, we'll zoom in so traders can see this. So we have our low of the day in place. The question we have then, are they working the low or are they working the high? They give us a redrawn high of the day in our 12 as our 12 candle window opens in the US session, and they work back into the low of the day before pulling away without taking out the low, and give us a redrawn high of the day on a 1, 2, 3. So again, traders that keep asking me, what is this 1, 2, 3, 1, 2, 3? Study. Whenever you see 3 bars, you're either going to be in a measured move continuation, okay, 1, 2, 3 sideways pin hammer, 1, 2, 3 again, or you're going to be in a stop hunt, 1, 2, 3 pullback. So we have our low of the day If we have a low of the day and we're working the low of the day, we're looking for a W formation. They come back the second time. Traders chase the bullpen hammer short, thinking this is going to follow through for the measured move before reversing that with a bullpen candle off the low of the day on the second leg. Okay, for the stop hunt back up to the high of the London session. Now, again, what I'm focusing on here is high and low of the day. Not saying every situation is a best trade setup scenario. But when you understand, and as we put all this together and look at the best trade setups, you'll understand the questions you need to be asking yourself to keep you out of low probability trade setups, to keep you in the best risk-reward trade setups at the time, at the high and the low of the day, and what the best setups will look like. And if you participate in different types of trades, how to fight for a better fill price. So this trade went down to the low of the day on the second leg. Traders who chase or who get filled at the close of the candles are getting filled 10, 12, 13 pips away from the numbers. So there may be opportunities to get better fills, including the spread at the numbers, to increase your odds of a 35, 40, 50 pip move as opposed to maybe 25. But in this particular segment, again, we're focusing on the highs and lows and understanding what we need to look for in order to know, are we working the high or working the low of the day? So again, a question I get asked a lot is, will this work on gold or will this work on, indexes? And, you have to test that out yourself. Any market that has a high and a low will operate in the same capacity. If we look at gold, just looking at the last few days, again, we have the Fed day, very similar to what we saw on a lot of the pairs. Big spike on both sides, hitting stops. You'll notice the volume gets trapped in the middle and then bang, bang, they hit both sides. But then they work the low of the day. They work back into the low of the day in the rollover in 3 pushes, 1 push, 2 push, 3 pushes. And in our Asian 12 candle window, they reverse that market with our engulfment and our 3 push pattern off the high for our lower geometrical structure and a break out of that level. So we have our low of the day in place as the session unfolds. And as that session continues to trade, not until we get into the Europe-London 12 candle window do we get a redrawn high of the day. The market immediately breaks through that, and you'll notice that that is at round numbers. So again, there are no swing highs in here anywhere. This is just a consolidation of candles. We get up, we get a little bear pin at the round numbers at 1950 before pulling back in our 12 candle window. They pull back, give us our bullpen hammer for the continuation long. So an example of a trend trade. So the market is breaking out, making new highs after our breakout of our geometrical structure. So again, just showing a momentum line. We get our bullpen hammer for the continuation, the breakthrough, and then the pullback. So we have a new redrawn high of the day. And again, asking ourselves, obviously we have potentially now the high of the day in place for the day. We have the low of the day, and we have a high of the day from Thursday's Fed announcement. We have a redrawn high of the day. The market breaks through that in our 7 o'clock stop hunt as we head into our 12 candle U.S. session window. I'll blow this up. The market then stop hunts back into the existing traders that are long in the gap time. So again, we're in an up market, makes a new high, they break the high, they're working the high. Traders have hit the large bear candle thinking that potentially this is a middle structure. We're in a trending day. Okay, we see a big candle like that, stop hunt candle, they go sideways in consolidation, engulfment. Hit it one more time. Then when the market breaks away with another bull candle engulfment, our middle structure is intact for our shortened W formation in the U.S. session back through the high of the day. So again, emphasizing not that these are ideal trade setups or that this is, the trade that we would have took. We're talking about assessing how price behaves at the high and the low of the day. We have a market that's broken out of a geometrical structure in a trending day, breaking out, making new highs, pulling back, breaking out, and continuing making new highs, pulling back, working the low, working the low. So we have a low of the day in place, a high of the day in place. They extend the range down, they extend the range up, and then they work down into the low, they work down into the low. There's our W formation for the continuation long. We head into our next day. The market in Asia confirms we have a redrawn high of the day. We have our U.S. session rollover low of the day. The market breaks down through that level and goes into consolidation, pins up into the box before pulling back and giving us a double bull candle, and then breaking back through our middle structure, back inside of our U.S. session low of the day. So again, we took the low out, pulled back, worked into it a second time, and then an engulfment and break back through that level for our shortened W. The market pulls back and retests that in the U.S. session 12 candle window in that first hour and a 1, 2, 3 stop hunt before continuing back towards the high of the day, pulling back one more time and working back up in towards the high of the day. Now as we head into the next day, we can see that that high from Monday is still intact, and we potentially may have a breakout scenario that could build into this. So again, we have potentially even a low of the week formation in place and possibly a day zero yesterday in gold. If we scrunch our chart back up, even go to a longer time frame, we can see that there is a high from last week intact, and that the market worked down into the lows of the week in 3 pushes before pulling back, working back into the low again on our Fed day. And now we're working back up into the highs of last week. If this market was to break through, we possibly could be looking at a measured move structure and possibly a W reversal formation off of the lows of the week. So we worked into the low of the week, into the low of the week. We put a high of the week in place. Our first target, if the market was to break back, would be to head towards the highs of last week, up above that 2,000 level. Currently, we're still inside of the highs of yesterday, and we're working the high of the week. We had a trend day on Friday. Yesterday, they worked down into the low, gave us a W reversal, went into consolidation in a narrow range day. So depending on how price behaves, will give us an indication if we're breaking out and continuing to work back towards the highs of last week. And looking at the euro, one last example, again, just working from simplicity about marking highs and lows. Monday, we'll just mark off our Monday again. We have our Monday in place, designated by the pink line. And we have our low of the U.S. session. And then we have a higher swing low that, as the market rolled over, gave us a new swing low of the day. The market worked down into that before pulling away and engulfing and then taking out Friday's high in the beginning of the Asian 12 candle window, giving us a new high of the day and then a low of the day in Asia. So we have our high of the day and we have our low of the day. The market was working down on Friday back into the low, and then it worked back up into the high, pinned through the high before pulling back and then giving us a new low of the day. And then the market proceeded to work back down into the low of the day, extending the range slightly, pulling back, and then rolling over and hitting the low of the day again. So we have a redrawn high of the day. So we have a lower high in Asia without taking out the high. We have a swing lower high in not only the first hour of Europe, but then they hit the high and the low. They expand the range, and then they work the low again. So we have one push, two pushes, and then three pushes, taking out the low, breaking through that lower swing low in the first hour of Europe before reversing. Although we don't have a full engulfment, we have almost 100% engulfment, and the thesis would be that if this trade breaks at the end of our 12 candle window on the third leg, that we could potentially now be going back not only to the high of the day, but continuing our move from Friday's strong trending market before it went into consolidation. An example again of a buy low scenario and in an already existing up move. The market breaks through the most recent swing high, so the last high before the low, goes into consolidation, continues that move with an engulfment heading into the gap time, but just prior to the US session 12 candle window. We'll just stretch this out. So again, we have our high of the day. The market breaks through the high of the day, pulling back 1, 2, 3, continuing. We're in the middle of our number box. So an example again of traders getting caught inside of a 25 pip box. Okay, we're going to focus on numbers in the coming videos, but the market breaks the high of the day, pulls back, hits it again, and then goes 1, 2, 3 down. So there's our stop hunt back into the trend with the engulfment. And then traders who went long, again, once it breaks through the double zeros would be a break even. And again, getting into this third level, we haven't spoken about ADR or anything else, but point again today emphasizing the highs and the lows, working the highs and the lows. We have our redrawn low of the day. The market works down in 3 pushes, and then heading into today's session, we can see that market's continued to break to new highs. But again, the beautiful scenario, this is a textbook situation where they put a high of the day in place, they put a low of the day in place, and then they work one side. They work down, pull it back, work down, extend the range, and then they pull it back and work it a third time for the engulfment off the low of the day for, again, possible measured move. We can measure the last structure that was in place off the last high before the low. The market pinned up just beneath that on the third leg, but again, they were working the low of the day. So hopefully you got some value from that, traders. High of the day and the low of the day, that can apply to the week. Are they working the high of the week? Are they working the high of the day? Are they working the low of the day? If we have a high of the day in place, are they working that? As opposed to a trending day where they break out and they will work back into the breakout to continue that trend. So print off your charts, mark off your highs and lows. Don't get caught on the inside. Let the market set up and put a low or a high of the day in place with that second leg structure. Keep it simple. Play great defense. And we'll go on to the next video where we will talk about timings.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.